Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy. We got a neat video here that came from one of our Patreon supporters asking for some additional help, and that was ULTY or WPAY. Should they switch? Is it a good move? Well, we're going to cover that today. I don't want you to miss a single update, and all we're trying to do here is help you think smarter about your portfolio and your income strategy. So if you haven't yet, hit that subscribe tab, hit that bell notification. You don't want to miss a single video. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. This information is provided in the video is for educational and entertainment purposes only. If you are considering financial investments or needing financial advice, always contact a licensed financial advisor. So let's talk what's happening a little bit about ULTY. We've been following YieldMax's ULTY ETF, and there are some clear warning signs. The assets under management have been declining. There's a notable yield discrepancy as the advertised yield is around 90%, while the actual trailing data suggests closer to 61%. So I'm not real pleased with that side of things. And the share price has dropped to below $5. That shows potential performance weakness. In October, got down to $4.88. Now, I know it has recovered since then, but it's still a very noticeable piece. And with that, there's been a rise and to an important question from many of our viewers. If ULT isn't holding up, where do we go next? And that's a great question. So I basically looked at this and said, well, what would be the closest thing to it? And enter WPAY. I call it the new challenger. This brings us to the Round Hills Weekly Pay ETF WPAY. This fund was hyped before it launched and started trading in September of 2025. The current price as doing this video is around $54.65. That's roughly a 3.9% increase since inception. Estimated yield is about 69%, which is roughly about 8 percentage points higher than ULTY's actual payout. So right away, there seems to be a stronger yield profile and a positive trending line, compared to ULTY's recent slide. So what I did here is I did a head-to-head comparison, which is ULTY versus WPAY. So when you take a look at it, the advertised price of 80% and WPAY's actually observed price of 69%. And when you look at the actual paying yield of 61% from ULTY, it just shows that WPAY is paying higher than ULTY. The other one we run into is going to be the price trend. Now ULTY is showing down 22%, while WPAY is actually showing a 3.8% growth. So that's a big difference. Now they're both weekly pays, so that's kind of a given. But the expense ratio, ULTY is coming in at 1.28 to 1.32 percentage points for the expense fees, while WPAY is only doing 0.99%, and that's been waived until 2026. So that's a big difference. You're paying nothing right now for basically 1 year on WPAY. So the waiver of that is a very big plus. It saves you basically 1 to 2% of expenses compared to ULTY. Now let's take a look at the head-to-head in returns. And what we did is we took a snapshot of 1 month to give you an apple for apple comparison. And right here, you take ULTY is down 6.08%, while WPAY is up 2.72%. And then when we take a look at the distribution snapshot, ULTY distributions have flattened out around 9 cents per share, trending down over the recent months. WPAY, through a newer and higher priced, has been averaging 70 cents per share in distributions. That's a dramatic difference in raw payout, though of course the share price is higher and this fund's leverage and risk levels are higher. So it's the trade-off. So let's take a look at the sector holdings now. ULTY invests heavily into technologies at a little over 40%. Financials are 23%, and other sectors about 15%. Now the holdings include Robinhood, Peltier, Coinbase, HIMS, the Rocket companies, some strong growth names, but the share performance still hasn't reflected the strength of those particular holdings. WPAY, on the other hand, is built differently. It owns slices of all the Roundhill weekly pay ETFs, like HOOW, AMDW, NVDW, APW. Each position is roughly equal weighted, about 7%, and is rebalanced monthly, keeping diversification consistent. This helps smooth the performance. If one fund spikes, it's trimmed back. If another one dips, it's added back. So risk and considerations. Both funds have heavy tech exposure. That means volatility is part of the deal. However, WPAY introduces a few extra variables. It uses a modest leverage of around 1.5 times, increasing both the risk and the potential return. Now it's only 3 months old, so it doesn't yet have a full market cycle to track record. When comparing, think about this: your risk tolerance, your income goals, your timelines, short-term or long-term, for income generating. So my take, and this is my educational opinion only, if I were managing my own portfolio, I'd like to rotate from ULTY to WPAY. Not because one is guaranteed to outperform the other, but because WPAY structure offers a better diversification. The fee waiver provides immediate cash advantages, and the momentum trend is currently positive while ULT's is just declining. But this is the key. This is just one piece of an income strategy and not the whole puzzle. No single fund should be in your entire portfolio. So whether you stay with ULTY or move to WPAY, your diversity across several income funds, the choice depends on your comfort of risk, yield, needs, and how these funds fit into the broader strategy. For me personally, I've reduced my ULT position and added exposure to WPAY, but that's my own portfolio decision, not a recommendation.
Thank you for watching.